We believe that it's sort of a blend of current cash flow to create wealth and also pay for luxuries that you might want to treat yourself to, in addition to some appreciation on the sale. And I think that's where some people have gotten into trouble, chasing those grand slams, swinging for the fences.
What's the number one secret to decoding commercial real estate and making sure you're making great investment decisions?
I think that you have to understand that you can't eat IRR, and that should not be the investment parameter in which you base your decisions upon. I know that a lot of people invested as limited partners and syndications, and when you have a choice of, do you want a 2.4 multiple or a 1.8 multiple or a 25 IRR, people think, well, I'm going to go for the fences and I'm going to look at that IRR with the highest number on it. And what's happened more as of late is that has not been the way to go. We believe that it's sort of a blend of current cash flow to create wealth and also pay for luxuries that you might want to treat yourself to, in addition to some appreciation on the sale. And I think that's where some people have gotten into trouble, chasing those grand slams, swinging for the fences. Real estate investing is about putting men on bases and getting them to score runs. It's not always going to be triples and grand slam home runs where you're clearing the bases.
Absolutely. I couldn't agree with you more. And so it sounds like you can't eat IRR, right? You can't count on it. And really it's looking at the current cash on cash return. I couldn't agree with you more on that. That to me, that's the most important thing when going into the investment, unless there's just some astronomical value add opportunity, right? Or just something that's so tangible, so proven that indeed you could buy this 200 unit apartment complex and 30% of the units have already been, renovated and they've increased $100 to $200 or $300 more in rents. So it's already been proven pro forma, right? And the cash on cash right now is sustaining and has a positive arbitrage, right? And a positive cash on cash. And you have some good debt in place. And then, yes, great. You can probably do a more realistic IRR, right? Moving forward. But again, you're buying it on that first intrinsic value that it can sustain itself. It can get around the bases, right? Versus the home run. Is that a fair summary, Irwin?
That's a fair summary. But unfortunately, most of the value add deals that are out there that have been syndicated, they went in upside down where your debt was higher than your going in capitalization rate. There was minimal, if any, current cash return to the investors. And as the prices continued to tick up for some of these value add assets, sponsors became a little more creative. They didn't grow the expenses at a high enough rate, or they took short-term floating rate debt and didn't buy a full-term interest rate cap. And now they're exposed because the loans are resetting, and you either have to buy an interest rate cap replacement, which is very expensive in today's market, or like with insurance, it went from $250 per apartment to like $800 an apartment. There was no rainy day fund. The deals got screwed down too tight. But yeah, if you can go into a value add that's proven and you can have positive leverage and you have set aside enough capital, I think those succeed. Unfortunately, we looked at one yesterday where the sponsor, I think, had a basis of $180,000 a unit, would sell it for 110, and he basically wanted $1 million over the Freddie Mac debt. And I couldn't get it to work. He had a floating rate loan with the rate cap expiring. He needed $1 million for the rate cap, and I just didn't see how it was going to work at all. And I think at that one, I'll revisit it after it's foreclosed by Freddie Mac, and I could buy it below the current debt.